part of why we're all here in person to have those conversations. But it is 3 after 10:30, so I would like to bring us back to business here. Next up on our agenda is the quarterly review from Empower, and joined us here in person as well. Gabe, turn it over to you, Tim. Just turn it right over to Gabe here. Or?
Yeah, I think so. I think this back half of the meeting, we were focusing on our OPEB system and sort of general. Now we're going to focus on the 457 for this back half of the meeting. And as I said at the end, if we need to push, the last item to next, I think we're going to keep that flexibility to see where this moves.
Great. Gabe, the floor is yours.
Thank you, Mr. Chairman, and good morning, everyone. Wonderful to be with all of you again, and happy holidays in advance because it's coming and it's coming fast. Obviously, we've got Chip here with me as well, and Chip is going to be providing a field report. I'm going to provide a really, really high-level summary here to keep in time with the schedule because Sarah's got a lot to cover with you all. We've got the Empower team. I see Melissa's up there. We've got Brian and Nick Marinelli, and I'll let Chip mention Nick in a little bit. But just as a reminder, before I get into some of these metrics, there's some upcoming share class changes. You probably have gotten some communication, but on December the 8th, when you log into your account, the funds, if you're in the Dodge and Cox, Impax, Calvert, or Vanguard, all those fund changes that Friday are going to move to a lower share class, resulting in a better performance for participants and lower cost to the participants as well. So that's just a reminder that those fund share classes are taking effect, and you'll see them in your accounts on December the 8th. As I said, Chip will be mentioning the field report shortly in terms of your participant engagement activities and things of that nature. I got some new tools available to me. There's a lot of information in here. The more and more it gets on the Empower platform, we're able to provide more. So I'm not going to go into all of these pages, but there's a lot of information there at your leisure to go through. And should you have any questions, happy to discuss that. But from just a high perspective, today we've got $105 million in the plan, representing 9,475 participants. That's as of September 30th. When we look at the plan year to date across the board, the plan has grown approximately $81 million. It's about 11% year to date. And the big surprise, I wouldn't say surprise, but the big distinction there is that the increase is primarily due to market appreciation, market valuations. So we had some really good market, and I'll share with that in a second. Distributions were like $52 million, and that's primarily due to withdrawals. But the separated employees, there's active employees and separated employees. The separated employees have the larger percent of the assets, which is why these are mature plans. So having those larger percent of the assets, they really contributed, if you will, to the appreciation of the plan. So with that, thank you, Bill, for sharing. There's an executive summary up on the screen there for you. So as I mentioned on page 3, 105.1 million as of 9/30. In terms of your plan on page 4, the average account balance is just under $85,000. And as you can see between the benchmark on our government book of business, above the average of 79, you're at 85,000. Then there's investment utilization, and we'll get into that a little bit, how participants are investing their money and the platform and the features that they're utilizing. And then, of course, the largest holding positions would be the large cap funds in your plan. So there's different strategies, right? There's My Total Retirement, which is a managed account, which is a professionally managed service. And you're going to hear things like do it for me, do it myself, and help me do it. So managed accounts, which is a fee for service, 35 basis points to utilize that service. There's free online advice, which is a snapshot of your account, should you want to consider that. Of course, target date strategy, your target date funds, asset allocation, which is Goal Maker, which I know all of you are very familiar with. And then the do-it-yourself. So the bulk of the strategies are the majority of individuals create their own. Almost 41% of participants, and I'll put some numbers for this later on, do their own investment strategy. Others utilize a target date strategy or Goal Maker asset allocation. I'm going to look at money coming into the plan. So I'm going to go to page 8. So year to date, we had $27 million come into the plan. We also had almost $44 million leave the plan. So that's a net negative cash flow of about $16 million for that quarter. Again, the things you want to keep in mind is, now that's primarily due to leakage, and I'll get into that a little bit, but keep in mind these are mature plans and people are using the money for what they need it for, what it's intended for. But here where I want to focus real quickly is the bottom on the line that says change in value. You can see a quarter-over-quarter snapshot, but look at the last 2 quarters. The second quarter, the market appreciation was 53 million, followed by another 40 million. So a $90 million pop in just the last 2 quarters in terms of market valuation, which is why those large balances are creating the higher valuations. versus the previous quarters where, the market's up and down. Now the government's open, which is wonderful. As I talk about contributions, and I should point out just real quickly to say, what we've been seeing at Empower the last quarter has been an increase, not primarily Vermont, but across our book of business, primarily more so in the private sector or plans, an increase in call volumes. Participants, the shutdown has really affected participants, right? They're taking loans, hardships, withdrawals, and things of that nature to try to make ends meet. So we have seen that go up. It'll be interesting to see if that starts to subside now as the government reopens, et cetera, so forth. So, but I did want to make that point. In terms of the contributions to your program, as I said, 27 million came in. 19 million of that, I'm on page 9. 19 million of that was before tax contributions, followed by some Roth. We continue to see strong Roth contributions, especially from younger participants across the platform. And the 2.7, that's rollovers. So when individuals consolidate and bring their assets, outside assets into this plan, you're picking up good rollovers there. So far year to date, strong rollovers. And then you can see the rolling 12 month over month below, month over month. So looking at a run rate of about, let's call it $2.5 million of contributions plus, some rollover dollars in. Okay. So that's money coming into the plan. Again, a good steady amount of contributions and rollovers coming into the plan. Always a positive sign. Now let's look at distributions in the plan on page 12. As I said, almost 44 million left the plan year to date. The majority of that, 37 million, you math majors, you can do that calculation, but about 2,529 transactions are due to separation from service. What is a separation from service? It's two things, really. People that have retired and are taking installment payments, right? They're still in the plan, but they're taking payments. And those that just took all their money and left, just roll over. We are continue to see, as more and more participants are reaching that retirement age, they are consolidating their assets. They may have 5 or 6 different accounts at various places. Their spouse's assets, they work with an advisor, for example, or themselves, and are starting to consolidate their assets. So you're going to see leakage come out of the plan. That's part of it. As I shared with you last year, and I'll be sharing in the first quarter, when I do a full calendar review, it's what's called the money motion report. There'll be not only additional analysis that I can now run through chat in my organization, but it's what's called the money motion report. I shared with you once to show you where all the money is leaving, but where's it going? What went to Fidelity? What went to Hancock? What went to this bank or that bank? So we'll give you some statistics in terms of you can see for yourself where the money is going on an annual basis. So that's coming into February month. There were 266 required minimum distributions paid out, 1.7 million, and there's more coming. That comes towards the latter part of the year, as many of you know. In-service hardships, credits, qualified domestic relations orders, and sadly, 113 death paid out type distributions representing $2.3 million. So that's the assets leaving the plan. In terms of back to the investment strategy utilization on page 15, just want to put some dollars next to those participants and what they're doing. So advice, managed accounts, 630 participants, almost $41 million. That represents about 5% of the plan's assets right now. And you can just go right down the list. The largest holdings are your target date strategy, 2,100 people representing 82 million. And Goalmaker, which is the asset allocation education tool, 2,700 of those participants representing 142. But the bulk, 3,800 participants, representing almost 65% of the assets and 40% of your participants that have done their own asset allocation strategy. That's $500 million out of the 800 million that do their own asset allocations. I do want to pause on the next page, on page 16, which is really, really a cool slide. We actually break down, excuse me one second. We actually break down active participants versus separated participants. And as you can see there, the good news here is that even when people leave the plan, now the goal is to keep money in the plan. It benefits everybody, except you can't contribute to it. But what it does do is it shows you that when your participants do retire, they leave the money in the plan and they stay invested in the asset strategies that they're selecting. They still have that ability. Years ago, people took their money out and put it in a bank account. Those days are gone. But as you can see here, the majority of the assets, so about 300, if you add them up, are with separated employees, and they're still staying invested, which is why we saw, as I mentioned earlier on, they hold the majority of the assets, and because they're holding those assets and the market appreciation raises all boats. So thank you retirees for keeping their money in the plan.
And you also, at another stride, mentioned that in the other category was capturing people rolling assets
Correct.
into the plan, right?
Yes.
One quick question, you mentioned money in motion, people
Yes.
going to different firms. I get, maybe they're looking for some type of advisory service. Is that my total retirement? Would that capture the services they're looking for, or is
Yes.
that tailored enough to?
Yes, and there'll be a deeper dive later into the my total retirement and managed account. So yes. Yeah, hi.
You mentioned that previously or in the past, members of the plan would take out their assets and put it into a more stable bank account. How far back are you talking that this trend has changed?
Well, I've been in the business since '88, and it started to change with the advent of mutual funds, probably in the early to mid '90s. To be honest, but that's ongoing. But the biggest reason why people did that is because people did not understand. They thought they had to take their money out when they left their first.
Yeah.
That's something we've been dispelling. And today, participants still think, hey, I'm retired, I got to take my money, right? And these guys are saying, oh, no. Because just for if you go back to No 457, it used to be when you joined the plan, you had to make an election as to when you wanted your money and when we're going to take your money, and you could not change it. Then they made a one rule change. But generally speaking, people were under that mindset that under 457, when I had that plan, when I retired, this is going back, if you've been working 30 years, if you've signed up, you were told back then that when you retire, you got to take your money out. That was what people did, but that's been dispelled. So, and I think you guys are not, because I think you know where I'm coming from, because we've been doing this for a while, 38 years, right? So
Well, just a different perspective.
it
you know,
is,
like
it is.
I have never been told that because my entire career is after that time
Yeah.
change that you talked
You're young.
about. So, yeah.
I love it.
You know, I'm working on it.
But you know, the beauty of that though is, and what's really gives me hope is that more and more participants are becoming financially literate. They're taking the interest to learn about this stuff. They're investing in all different things now, especially the younger folks. I mean, the young folks not only are getting in Roth for tax reasons, but they're asking about cryptocurrency. I mean, whoa. I mean, it's pretty cool stuff if you think about it. But yeah, so we're slowly dispelling the myths of that. And the biggest advocates are you participants that are still separated from service of your plan. They tell their colleagues and friends, no, you don't have to. I retired. Here's what I'm doing. Yeah. So the word is getting out. It's slowly being eradicated, but there are still people that do believe that, albeit a small majority. Okay. No, thank you. Now, the next couple pages breaks down all of those investment strategies. How many participants are utilizing the advisory services? So on page 17, there's 630 participants, and you'll see the growth when it was first implemented with the new contract. So we have 300 participants, now we're up to 600 participants. Generally speaking, and Sarah will get into this more, when you look at kind of this landscape, you'll probably see a 10% participation rate in advisory services, because remember, you have to pay for this. Right. So that's really the difference, but I'll let Sarah get into that. And then we've got a lot of demographic data as it relates to all of the different services, goal maker, demographics, balances, go into goal maker participation. I'll just go to the last two pages here real quickly on page 25 and 26. This is pretty cool, I think. It's a snapshot of all your funds and where it's invested, what's in managed accounts, what's in target date, what's online, goal maker, risk-based, So again, you'll see all of your assets there and how those funds are invested. So, and the rest is just demographic data. And before I get into, and then there's some the communication and activities, but I'll let Chip speak to that. But before I go to Chip, I just want to real quickly touch on the self-directed investment account, which is on page 39 of the presentation. So as of September 30th, again, this is the Waste Trust that we've been talking about for years now. It's just under $21 million, representing 684 accounts. And on page 40, you'll kind of see the quarter. This is a good page, quarter over quarter. And it's been hovering around, $500,000. There was some big disbursements, almost double that in the fourth quarter. And I would suspect the end of the quarter this year, you'll see a lot more disbursements, again, for those individuals that have those accounts. So that's all I had prepared to try to keep this thing moving here. So before I hand it to Chip, are there any questions that I can address for you? Yes, sir.
If I just jump in on the
Please.
On the SDIA, I do think that it has been, at least in all the time I've been here, we've seen that number kind of going down. And at a certain point, I think it'll make sense to move that into another vehicle that we already have instead of maintaining a separate plan. I don't think we're there yet. And I do intend over the next year or two or something that's on the sort of longer term work items that I want to work with RBK on and kind of think about options. What's a good plan for it? But, once we get to maintain a separate plan for this small number of people, I'm not sure makes the most sense. So just wanted to put that on your radar as a work item that is down the road, but probably coming.
I was gonna ask that question actually, so thank you for that context. I was gonna ask, but we anticipate this actually being drawn down to zero over the time or something else coming up. Sounds like stay tuned on that.
I think so. And then the other point, I just wanted to make sure that, Gabe, you, is the money in motion report that you have where you kind of talk about where things are going and coming. Is that going to be a year cadence that you'll provide that to us?
Yes, I intend on doing it on an annual basis, and if you
Okay.
need it more frequent than that, I can definitely look to see if I can get it more frequent, but most clients like it on an annual basis.
Yeah.
As a look back for the full year. And then from that point, they can coordinate kind of messaging. They will
Right.
go out, look at their population. There's a lot of events. Any closer to that just creates a little more confusion.
Yeah.
That's so,
No, that
yes,
makes
on an
sense. I
annual
just wanted
basis.
to make
Yep,
sure
yep, absolutely.
board members had a sense.
Any other questions?
Yes,
Hi, Jay.
on the account registration and protection on page 5. Wondered about outreach to non-registered participants and participants who have never logged in. Those two items that you got exclamation points next to.
Yeah.
What's the strategy for dealing with those?
Feed them to Chip. In all seriousness. So as I said, we're able to get more and more data, and it's always surprising to a lot of clients when they say, what do you mean only 2,000 people have not registered? What do you mean 2,000 people don't have a phone number? Well, there are people that don't have a phone, a red line anymore, use cell phones. But there are people that, and we found the majority of these people to be people that have retired years ago.
Yeah.
And some don't even know they have an account, believe it or not.
Yeah.
Or some may be getting a statement that has little dollars and you just leave it and do nothing with it, or they throw it out. Our strategy is, with all our communications, is to have members reach out to Chip and team. When we see a number of, these people haven't even registered at all, we supply Chip a list of with the names that we have, and to work with staff to try to track these people down. Do you know who this person is? Is they say working? Do you have any more information to try to get to Chip so they can make and they have reached out to participants when they can, try to make an appointment, to try to make a phone call. Sometimes they're lucky and they get responses. A lot of times, radio silence. So that's all we could do.
Yeah,
So I could
my
do it.
last job, I had a plan with, I think, about 300 members in the plan. And we had around 10 that we just didn't have an address for, didn't have any contact with.
Yep.
So one of my challenges was doing what you do, Chip, was, see if I can find those people, find ways to find those people.
And we have services, when we send out a statement, for example, we have a service that comes back. So we go work with the post office, see where's the last on file. Sometimes it differs from what the state may have.
Yeah.
So we do utilize those services, but some of them, nothing.
It's labor intensive to try to.
Extremely
track
labor
this down.
intensive. Yeah, but it's important to have that data there to see who's doing what. To us, what's most important is the people that don't register.
Yes.
That just, it's like,
Yes.
that's too much risk.
Yep.
So that's our emphasis. How do we get people that are not registered to register?
Mhm.
That's
Jay,
first thing.
Towards that end, once a year, the VRSCA puts out a newsletter to all retirees.
Yep.
And so we had a whole section in the most recent newsletter encouraging people to make contact with Empower.
Right.
Just trying to maybe reach people whom,
Yeah.
hard copy with a phone number is
There are gaps even in that safety net, because I'm a former state employee, but not a retired state employee.
so,
Right, so I'm
right. So
not
you're
on
not
your
on
list.
that list, right? Okay.
But we appreciate that, working together with that, and so we're working with them. This is one of the things one thing we're trying to do even more of than we have in the past is reach out to retirees, because that is a group that isn't as likely to register their
Right.
account and update their information. So we're scheduling time here, thank you, Bill, to schedule appointments with retirees specifically to try to reach that group. And I wanted to throw out that the first 3 things that we say to people when they meet with us face to face, number one, I spent 7 years selling life insurance when I was this big, and I handed out too many checks to ex-spouses and things back then. So it's a pet peeve of mine. The first question is, let's look at your beneficiary, make sure that's up to date. The second question is, let's look at your personal and contact information to make sure that's up to date. And the third thing is, have you registered your account? Let's get you online right now. So the people that we talk to, the people that know to come to us, we're definitely, that's at the top of the list, actually, the things that we
Sure.
talk about. And then we take a deeper dive into things I'll talk
Yeah.
about.
Yeah.
So, yeah, and yeah, we're fortunate to be working with a lot of different departments these days.
What would you say the percentage of of the people who haven't registered, we'll say, or you don't have their email or phone number? What percentage are retirees, and what percentage would you say are just employees that left state service without retiring? Do you know?
Majority retirees.
Majority are.
These are people that are getting either a retired minimum distribution, or they haven't, they haven't done anything. And all of a sudden they get a mail letter saying you have to take an RMD, and they contact us, and then we're like, thank you for contacting us. Finally, now we can get all the information we need. So it's primarily, Beth, it's primarily retirees.
Interesting.
And it's
That's across our platform. That's like an automatic.
it's like
across our platform.
3,670 people. That's not small.
Oh,
If I may put the plug in for one of the reasons why we are looking for another staff member in the retirement division is to have a bit more capacity on this type of thing. Empower has a lot of comms tools. We have a comms person that they have. What we struggle with is having the time and capacity to take full advantage of that in a strategic way.
Right.
We have been moving resources into this space, bringing RBK on, trying to have a bit more of an intentional oversight of these plans. One thing that came up in yesterday's meeting that I didn't know for another system is, we're on par with number of beneficiaries on file in this plan, but other plans are below. And so how do we utilize their tools to get that out? And it's not an area, in the juggling priorities that we've had the ability to really focus on. And a big part of why we're looking for that extra capacity is to help do that more intentional way.
Yeah.
Good. I'll just keep putting that plug in, like probably all year.
Thank you for the questions. Appreciate the dialogue.
One quick question about a number I noticed that might not be meaningful, but figured I'd ask anyway. I was looking at the investment strategy utilization,
Yes.
and the do-it-yourself strategy, the only category of strategy where the percentage of assets significantly outpaces the percentage of participants. And I was wondering if there is a set of characteristics about the people who are in that category or the decisions they're making that would explain that, or if that's just happenstance.
But
When I first started doing this a couple days ago, back in 2002, we didn't have these other options. All we had was do it yourself. So
okay.
for the first, from 1980, 81 up through, that was the only option.
That
So
explains it.
yeah,
Okay.
that's really it.
Thank you.
there you go. That's the answer. Love the questions. Thanks.
Yeah, good question.
All right, well, that concludes my section. Of course, you can always ask, and thank you to everyone that's on the phone there that I can't see. So, and to my back to any of those people. So, Chip, far away.
I will be very quick. I
It's
know
a
we're on the
buck.
schedule here.
Yep.
I think we mentioned last time that one of our local representatives, Gillis Owen, has moved on to other things. And we have since hired Nick Marinelli. Hopefully Nick's on the phone. I'm not sure. Nick is a former state employee. He also spent 7 years in the Air Force, was a park ranger. Somehow he's lived much more life than I have. And he's younger than me. That kind of bothers me. But very smart guy, MBA. Going to be very handy guy to have around. He'll handle most of the southern part of the state, as well as Chittenden County and some of central Vermont. So he's going to have a large footprint that he'll be taking care of for us. And just wanted to let you know we have him here. He's been through some extensive training, and he's just now getting out in the field and meeting with people individually. Poor guy's had to spend the last couple of months with me, so give him a break now.
I'm sorry, does he have state employment experience?
Yes, the state of Vermont.
Yeah.
Yes. Yeah, he did something. Is he there? I don't see him. I know he's not feeling well. He did something with finance. I think with AOT for a while, and then with maybe DCF.
Cool.
All of it in the finance section.
Great.
And he was licensed when he came to us. He'd done things outside of there as well. So he was very, very, we were lucky to find such a good candidate.
Great.
Okay. So, one of the stats I had is, the reps have done just under 100 beneficiary changes. I'll throw that out there that we've done across the table for people. The one thing I'll hit on is the number of people that we've been fortunate to work with. Mentioned retirees, HR, we just finished up the state benefits fairs. They invite us to that every year. We appreciate that as well. We do meetings for the corrections office of Vermont State Police, pre-retirement seminars with the retirement office. I just sat at a table again with Don, parent yesterday. So we're very lucky to be so connected because we all draw people to the seats. You know, we all work together and we're able to help more people that way. So we go to the Retirees Association meeting every year, things like that. So happy to continue doing that. So far this year, we've had over 1,500 appointments with people, virtual and face-to-face. Half of those were RRRs, retirement readiness reviews, where we sit and take a deep dive with people and really look at where are you, where do you want to be, what do you need there. That type of meeting has been going very well. For time's sake, I'll just jump to questions. Anybody have any questions for the local things? Well, good deal.
The VSEA retirees chapter, which is different than the organization Beth represents, also has an interest in having you come to their annual meeting. I think they had some difficulty reaching you this past annual cycle, but I just wanted to express that
Okay.
they do have an annual meeting, I think late August. And
Okay, who could I reach out to?
Eric, do you know
No, I was actually making a note to make sure that, all retirees had an opportunity to kind of catch up.
Absolutely.
I have to follow up on really who would be the best contact.
Sure, if you email VSEA at vsea.org, a member of the staff there, they do the retirees chapter.
Good deal.
I am wondering if it is possible they had your incorrect email, Chip, because I do know that happened with someone here that was trying to reach out to you and we were able to connect the two of you. So I think that could have been a
So I'll
possibility.
reach out to you and we'll go from there. It's also, we've been short-staffed too, so I don't want to blame anybody else. It could very well be me. But we'll make sure we get it
I
next
said
year.
I was busy. You must have been busy.
I was a little busy.
Thank you.
Absolutely.
Any additional questions for Chip or Gabe?
On behalf of the Empower team, thank you for your business and opportunity to serve you and your members. So with that, Sarah. Tim.
Yeah, thanks. And so next up, we'll turn to Sarah for a review of, general markets overview, review of our funds. This will be the first time we're going to look at some specific funds after adopting our investment policy statement and watch list policy. So I think you'll see a recommendation to put some funds on watch. And I think that's a really, ultimately a positive development, putting some more structure around our oversight of these funds. So Sarah will walk us through that. Then an overview of managed accounts. So that's going to be, focusing on my total retirement and just providing some background education on the space. In advance of, we're not recommending any action at this time, but it's work we're going to be doing upcoming. And so, when and if we come to you with something, we don't want it to hit cold. So part of this is just kind of building some of that muscle memory on this topic. And then I am a little nervous about time and whether or not we'll get to the 457 fees. That might be something we put later, but we had brought that issue up before. There's going to need to be an increase there, and we have some ideas for that. We'll see if we get there. If not, we can perhaps punt that to the next meeting. So with that, thank you for being here, Sarah.
Good morning, everyone. Thanks for your time today. Great to see you again. So before I jump into the plan update, maybe just a quick capital markets update. Show you also the news last night with Trump signing the spending bill and ending the longest shutdown in U.S. history. And obviously before that, everyone was only talking about the shutdown exclusively. That was the only topic. But before then, there were other economic topics on people's minds. One of them obviously was tariffs. That's always been a topic this year. There's a case that the Supreme Court is looking at now, hearing that is questioning the legality of the tariffs. So that is something that puts a lot of questions around the path of tariffs and tariff negotiation going forward. Of course, if those tariffs are overruled, then this will be a good news for the markets. But on the other hand, it also puts into question how the government is going to refund those tariffs that have been paid already. So that's something to think about. But we don't expect any news on that until months or 2 months from now. Another topic on everyone's mind this year has been just the Federal Reserve. As you may recall, the Fed cut rates twice this year. The first one happened in September, and then the second one was in end of October, bringing that main short rate down to 4%. Now, this is a big shift because for almost 2 years now, the Fed has been trying to cool inflation, hiking rates. There was a lot of concerns around inflation. It's just after the pandemic, and now it's easing. So we're taking our foot off the brake. And the Fed made it clear that the goal here is not to run it hot or stimulate the economy, but to want to make sure that, given the softening that we saw in labor market data, we're not really penalizing the market or maybe having rates be too high. So the Fed made it clear they're watching markets, they're watching the data. It's going to be data dependent. There has been a lot of expectations of another rate cut at the upcoming December meeting. This is now, again, less certain. We haven't seen any October data because of the shutdown, but a lot of private information does suggest that inflation is still running hotter than we want it to be. So now the market is baking in less than 50% chance of another rate cut in December. This was up to 85% at one point. So we'll see how it goes.
Can I just make a note to folks? This chart that you're seeing up there isn't in your packets. Our packets are for September 30th, and Sarah put together some additional information more current as of the end of October. So just in case you're wondering why that might be a little different.
Yeah, no, thanks them for that. So yeah, I'm happy to share that also after the meeting with you all. But this is showing the most recent data as of end of October. And on the top right-hand side chart, you can see the path of those three main economic data points: GDP growth, unemployment, and inflation rate over the last few years. And as you can see here, the GDP growth, which is the darker gray line, has been actually, it took a hit earlier this year. It was actually negative. So the economy kind of shrunk a little bit in Q1. And that was because of a lot of imports that happened in Q1. People were front running those expected tariffs. But then in Q2, the economy really bounced back, and GDP was around 4% annualized. Expectations for Q3 are positive, but not obviously as high as Q2, which was abnormally high. But with government shutdown since beginning of October, there are expectations that may hurt some of that economic data points as well, may hurt consumer spending potentially in Q4. So we'll see how that goes. Inflation, which is that lighter gray line, has been coming down certainly from its high of around 8% at its peak in 22. But you see that it has kind of stalled in 2023 and 2024. And that has been the concern. And that's why there's a lot of debate about what the Fed should really be doing going forward. The goal of the Fed is 2.5% or 2%. There are a lot of people thinking that maybe the new normal now is 3% instead of 2.5%. So we'll see how it goes. And finally, if you look at the unemployment rate, which is the blue line, this has been trending up slightly higher over the time period. Now it's at around 4.3%. But just a reminder that 20-year average unemployment rate has been around 5.8%. So that is actually considered close to the record low for unemployment. We have seen some softening. There's a lot of, we're seeing slowdown in hiring, but firing has been slow as well. And so we haven't seen a lot of employers looking to fire people. Everyone's being cautious and waiting it out with the tariffs. This picked up slightly, but still we're still overall in a good place with labor market. Consumers are still spending. And based on everything we can see right now, we've certainly avoided anything close to a recession, which a lot of people were predicting for this year. Now, as to markets, if you look down a couple of slides, as of end of October, the S&P 500 was up 17.5% this year. Hard to believe, given all the volatility and uncertainty that would be here now. Emerging markets, Asia, Latin America have done even much better than that. I think the Hong Kong index is up double that, around 38%, I think, as of yesterday. In terms of bond markets, things have been a bit more volatile. You may recall earlier this year, rates on the longer end went higher because of all the uncertainty around the deficit, around inflation being higher. But after those 2 rate cuts, rates came down again back to where they were about a year ago. It was over the 10 and 30-year treasury rates. And bond markets, as you look here, year to date, the US Ag, which is an index of high quality investment grade bonds, is up 6.8% year to date. So not too bad for a safe bond index.
Derek, can I stop you and ask you one question there? In the presentation, there's a slide that shows 10-year rates versus the dots,
Right.
the Federal Reserve forecasts. They diverge.
Yeah.
What's the dots suggest lower interest rates, the treasury market suggests higher. Seems like an interesting dynamic.
Yeah, which is why we put it here. So a lot of people assume that once you cut rates, the whole treasury yield curve will come down by exactly that amount.
Yep.
But what the market is actually baking in is that the longer end of the treasury curve will remain higher. So as you move actually from now till 2030, the market is baking the reverse of that on the long end. It's baking an increase in the 10-year treasury rates. One reason that Trump's administration brings up as important for cutting rates is that we want to bring down that mortgage rates down, bring down those housing costs. And that relationship is not super clear because those rates are more connected to that longer end of the curve than the shorter end. So that is something we like to remind plan sponsor of. If when you think about treasury rates going forward, think about how the shape of the curve will change, not just what the rate cuts will look like. Because oftentimes when rates are cut, that longer end goes up for a lot of reasons. People think inflation may stay as it is, or maybe even increase. People think about the deficit. People think about all those other variables that will will change as well as you move those rates down. So that is, it is an interesting relationship there. Thanks for pointing it out.
Thanks for the explanation.
Sure. All right. So all in all, I think the story here is in the first half of this year, the third quarter, the economy's really been resilient so far, and markets just cut through all that noise. And we expect the markets to do the same, but we are hopeful also not to be pushing our luck. So we're watching a few different variables there. Obviously, with the government shutdown out of the way, that is one uncertain data point that has been cleared. The tariff case is one thing we're watching. We're also watching market valuations. Something a lot of people are talking about now. We have a number of different charts there, but this is one as of end of October on the screen here that shows U.S. large cap equity compared to the historical average, and it's not even. And we all have a similar one, I believe, in the deck as well. So U.S. equity valuations are not even in the realm of the historical averages for large cap. Valuations are too high, and that's driven by high-tech, technology stocks, AI optimism that really pushed valuations potentially much higher than a lot of people expect. We will see, in terms of revenues and cash flows, how much of that will materialize, especially given all the international competition we're seeing today. So That is also something we're watching, and obviously everyone is watching the next Fed meeting in December. We'll see how that goes. Whether markets still hopeful for a rate cut. So, but the Fed is trying to temper those expectations as much as possible. So if they need to keep rates where they are, markets doesn't react very negatively. So more to come, hopefully.
A question related to the high price to earnings ratios regarding technology in the US markets. Are we seeing similar PE ratios in foreign markets as well, or are they managing their expectations in other parts of the world?
Yeah, it's a very US phenomenon. Unfortunately, we actually have a chart on that next page that looks at page 13. I'm sharing it here also. That shows international equity valuations relative to their long-term averages. And the story is quite the opposite. A lot of money has been flowing into US markets, or a lot of foreign investors have been investing here. Bless you. And a lot of those in equity markets are actually undervalued given cash flows, given the earnings. So this year, some of that has reversed. We've seen a lot of growth, money flowing into international markets. We've seen a lot of higher returns in those markets. Will that trend continue, or is it a one-year phenomenon given the uncertainty that remains to be seen? But a lot of people are expecting that we start to see the benefit of diversification today, and it's helpful to kind of try to split your bets across markets. Don't put all your assets into just the S&P 500. It has worked for years. It's been the best performing capital market for many, many years. But a lot of people think that just expectations are just too high right now. So,
thank you.
Of course. All right. With that, maybe just a quick update and give, and Chip really did a nice job here, but so I'll try to be more focused on performance. Starting with the SDIA, this is fully invested, as you know, in the State of Vermont Stable Value Fund. This is a multi-manager commingled fund. It's an institutional quality strategy. Our manager research team has been evaluating it more closely recently, and we really like them. They have, as you can see here, have done really well compared to peers, and the benchmark that we're using here, which is a benchmark of other stable value funds. As you can see, they have outperformed their peers. We will talk a bit more about organizational changes with the strategy that are driving us to potentially recommend placing them on watch. But that recommendation has nothing to do with its performance or the team managing the strategy today, which we think is still a strong team. So more on that later, but maybe jumping to the 457 plan. As you can see here, there's been strong growth in assets relative to the second quarter, and a lot of it is driven by performance. If you look at the asset allocation between target date funds, passive and active, it hasn't really moved much over that time period. So, and cash flow also do suggest that there has been minimum movement between asset classes there. When it comes to maybe some high level plan statistics we show here, overall, a chart that I would like to just point out quickly, the bottom left chart. We think it's really important, as Gabe mentioned, to watch those cash flows. There are a lot of separated and retired folks in the plan, especially in the older cohorts. It's really valuable to try to remind folks of the value proposition of the plan, because if all those higher balance older folks decide to leave the plan, that changes the economics of the plan. That changes your ability to negotiate fees, investment fees, and negotiate record keeping costs. So something all plans are thinking about, especially supplemental plans, and public plans more specifically, where folks are really primed to think that they should take their money out. This is really important to reiterate and highlight to folks, because it's a win-win for everyone. If you look at balances on the top right-hand side, they have been going up despite those outflows because of that good market performance, but that obviously can change if market performance shifts. We track managed account by age cohort on the bottom right-hand side. This is a new service that was added with the transition, so we think it's helpful to track, and we'll talk more about that. It does show more enrollment on the younger end of the participant cohort, so something we will dive deeper into at the future meeting and later today. This slide shows how folks are using the menu. So this is fully focused on participants, and I'm not going to repeat what Gib already said, but just wanted from a high level to point out that if you look at that what we consider do it for me bucket, so that's everyone who would like an asset allocation fund or service, so they don't want to be managing their asset allocation actively, you'll see about 58% or so of the participants in the plan have opted for a do-it-for-me fund or service. And that's pretty much in line with what we see in other plans that are more mature like yours, where it's in the 60-65% range. Of course, most other plans don't have something like GoalMaker. So whereas you have about 28.5% in GoalMaker, those folks would typically be in target date funds in other plans. So you also, for folks who want to manage their own assets, you provide them with 18 different building blocks. 34.5% of participants are fully using the core menu to manage their investments. And then you have 12 people in the self-directed brokerage window who want to, build their portfolios from scratch. We rarely see high usage of brokerage windows, so that's not unusual. And then just pointing out the two most popular options today are the Vanguard Institutional Index Fund, which is an S&P 500 fund, and the Stable Value Fund. Those two funds are generally the most popular in most DC plans, which is why we kind of remind sponsors that it is important to have passive options in DC plans. Participants do appreciate those low fee options, and they have done obviously pretty well long term. So this has been a really good bet by participants in both retail and institutional plans to put money in those low fee options. With that, just switching gears, looking at the monitoring dashboard, we've looked at this one before. This is a dashboard where we try to summarize some important qualitative, quantitative indicators that we think are important to just look at once a quarter. Under the qualitative indicators we're showing here, so we will flag any changes that we think may impact future performance. There are always changes happening, team turnover, people adding or people leaving strategies, but we will only flag things that we think may have an impact on performance or that we think is meaningful. We also show our RVK ratings for the strategies. We show how their fees rank relative to peers. And then we take a long-term outlook on performance relative to the benchmark and relative to peers. As a reminder, for passive options, peer performance comparisons are not that relevant. So it's really only important to focus on how they perform relative to the benchmark they're tracking. So we will give them a green rating if we think their performance is in line with expectations for the asset class, and it will vary by asset class. And then it's red if they underperform or their performance deviates significantly from the benchmark. And for active managers, obviously, peer group performance will be important to track as well. Maybe very high level, your T. Rowe Price target date funds, we really like them. They like to benchmark themselves against the custom benchmark that they created that looks at their strategic long-term targets for asset classes. And they will make tactical positioning relative to that benchmark. And what this is excess return columns are showing is that they have underperformed their strategic targets over the last 3 and 5 years. And that's because with market valuations where they're at, they have decided to maybe temper down their allocations to equity relative to the benchmark and have a more diversified portfolio away from US equities a little bit, which has hurt their performance slightly. But if you look at their rankings relative to peers, despite that, they have actually outperformed the median peer. And that's because generally speaking, their glide path is the most equity heavy, one of the most equity heavy glide paths in the market. And this has been a really good bet that they have made to have that higher allocations to equities, to focus on, capital accumulation for participants. This has really helped.
So they're underperforming their benchmark that they created, but outperforming their peers in
Exactly.
target.
Yeah, exactly. So yeah, obviously, long story short, despite that apparent underperformance, we're not really concerned with them as a manager. They have really done well long term and done well by their investors. If you look at your passive managers, also no qualitative concerns with any of them. Generally speaking, most of them are positively rated by us, meaning we think they are best ideas in their respective asset classes. One manager that we flagged here is the Vanguard FTSE Social Institutional Index. This seems to have tracked its benchmark slightly wider than we would have expected for a broad U.S. equity asset class or fund. We would expect less than 10 basis point tracking, so that it's been like 13 or 12, so not significant difference. And it's also part of it is driven by fees. So gross of fees, their tracking is around 5 to 7 basis points. I think their fees are like 7 basis points. So other options tend to have lower fees, but because it's an ESG index, its fees are slightly higher. So long story short, despite that, we're not really concerned with that. We do expect their fees to come down over time as those options start to see more assets, and with scale, they can bring their fees down like we see with other strategies.
Let me interrupt, Sarah. Is there what is the array of ESG alternatives in that same asset class?
So in the passive space, there are actually not that many options.
Right.
I think Vanguard is a pioneer there,
Yeah.
offering that FTSE social index, and it's the only one that comes to mind. Honestly, I'll take that back to our ESG sustainability team, and because I bet there are new options today that I just may not be aware of.
Right.
That are. But yeah, Vanguard definitely pioneered that space, and
I think they've done a good job. It's a fund that I've been watching for a long time, and I think they really do it well. But I'm curious if there are viable alternatives to that.
yeah, no, great question. I'll take that back to the team and circle back with you. But yeah, I totally agree on performance. If they have, I like to kind of remind myself that they have underperformed the benchmark slightly, but that benchmark has outperformed. If you look here, the S&P by 1.5 basis points or so, or 1%. I mean, over the 1 year period, which is not a small achievement. That's a really tough benchmark to beat, and they have done so actually over even the 10-year period. They have outperformed. So yeah, it's been really one good place to invest in ESG.
Am I reading this table right too? We have the same dynamic here that was going in the target date funds where it's underperforming the benchmark, but it's performing well relative to peers. Right? You look at the rank column.
That's right.
Yeah.
That's right. So we're comparing it, and we think that's important to do relative to non-ESG peers, because the DOL has been pretty clear. You don't want to compare yourself just to sustainable options. You want to be able to outperform peers that don't have that mandate. And that's what they did.
Okay. Thank you.
You're welcome. So with that, we wanted to, as Tim mentioned, note that there are your active options have generally done well, with a handful of exceptions that we wanted to flag for you today. There are actually 3 funds, to be specific, that are in the 457 or the SDIA that we think would be good candidates for the watch list. And just as a reminder, being on watch doesn't mean that those are strategies that we think need to be removed from the plan. A lot of the times, most times, in fact, those strategies camouflage and just but it simply means that they're under review because of either significant changes to the firm or to the strategy itself that we think might impact future performance, or that we have seen some persistent challenges in their performance in the recent past. So any strategy can underperform for 1 or 2 quarters, but if it's more persistent than that, we'd like to dig deeper, make sure we understand its drivers, and make sure there's nothing systematic or nothing with the manager's philosophy or approach that causes that underperformance. So with that, the strategies we're recommending for watch are the Vanguard US Growth Fund. So this strategy has obviously, as you can see here, and maybe we can, let me go to the performance itself and to show you. So the strategy has underperformed its benchmark. And I just want to say the benchmark here is obviously the large cap, the Russell 1000 Growth Index. This is by far the most successful benchmark over the last few years. So it's a tough benchmark to beat. If you look at the median manager in the space, however, they also underperformed by quite a lot, the benchmark. So the median manager underperformed by, I think, 3%. So over the 1 year. So the median manager's return was 21% and the benchmark's return was 25.5%. So that's 4%, I'm sorry, of underperformance. And it has been kind of persistent too. It's the 5-year return doesn't look much better. The 7-year, it has been challenging for active managers, and a lot of plan sponsors are actually thinking this could be a space where passive play might make sense, where that it's just too challenging, it's too competitive, the performance is too concentrated in certain companies each year, that an active manager basically needs to hold 4 stocks to compete with the benchmark. And obviously they cannot do that. They want to hold 30, 40 stocks. So, but that's not why we're placing them on watch. Despite those challenges, I think the reason we are placing them on watch because this is a strategy that is managed by 3 different managers. It's a Vanguard strategy. It's sub-advised by let me bring my notes. By Bailey, Gifford, Wellington, and Jensen. So they each each manages percentage of the strategy. And there are upcoming retirements at 2 of those 3 sub-advisors that are within their lead PM team. So Wellington has a retirement coming up in end of this year, so next month. And then Jensen has a retirement coming up in Q2. So when you see meaningful PM changes like this, we might see a change in the strategy direction itself going forward, and that might impact performance. So in those cases, we like to put them on watch, take an even closer look at the near-term performance. Like I said, it's a challenging space for active, but they actually done pretty well relative to peers. If you look at the 1 performance or 3 or 10-year performance, they have done pretty well in a tough space for active, but will that continue going forward? That remains to be seen. So that's why we're placing them on watch. The other strategy we're recommending is the Impacts global strategy. This is managed to a global benchmark, fully equity, but mostly in the US, but it also has international exposure. It has, as you can see here, it has underperformed meaningfully the benchmark, which is MSCI World, and non-ESG peers. A lot of that is driven by how they are managing the strategy. They have a quality bias. They try to, they've obviously had minimal exposure to the Magnificent 7 and technology overall. So that hurt their performance. The team, we've been talking to them. The team has taken steps to mitigate losses, mitigate their tracking error relative to the benchmark, while staying true to their philosophy, their ESG mandate. So they are still positively rated by us. So we still have conviction in their ability going forward, but we'd like to keep a closer eye on them. And then finally, the last one we'd like to place on watch is the Vermont Stable Value Fund. I alluded to that earlier. They have done well, as you can see here, relative to the benchmark. They have done well relative to peers, but there has been organizational changes with Mission Square retirement, a lot of cash flows, a lot of clients leaving the Mission Square retirement, which meant a lot of cash flows left the strategy itself. And at the same time, there's been a lot of PM turnover this year and then 2 years before that. So with that significant PM turnover, we'd like to keep a closer eye as well. The person managing the strategy, is tenured and has spent a long time with them. So we're confident in him, but we wanna see continued performance from them going forward. We want to make sure that they continue to invest in the strategy and its team, and they maintain that outperformance. So these are the 3 strategies we're recommending for watch. We summarized that here for you all. Any question about that? I think our process for placing a manager on watch, it means for us that going forward in the next few months, staff and RBK will talk about those strategies. We may bring you updates more frequently on them. And we have a general monitoring period in the watch list of about 90 days. Afterwards, we would come to you with a recommendation and a rationale. That recommendation could very well be there's still some uncertainty, would like to maintain them on watch, but it could also be to remove them from watch or to potentially think of a replacement or a termination. But yeah, the goal here is to just have a structured review, a closer monitoring, but yeah, so more to come on that.
And it's really to kind of document our decisions or non-decisions on this space. So you'll recognize, definitely the impacts from prior reports. Joe would have them and flag them for, to keep an eye on. This is meant to be a little bit more formal, place them on watch. And then, in that 90-day period, if we want to take an action or not take an action, we would have that discussion and memorialize that in the minutes. So that's, I think, some of the fiduciary oversight advantages of having this IPS and watch list in place. That's what we're moving towards. And so this would require a vote, and we would, staff would recommend the board consider a motion to place these 3 funds on the watch list policy.
So moved.
I'll second for the sake of discussion.
My question is, how does the board taking this formal action of putting these 3 items on the watch list affect other fiduciaries' perspective of these funds? Since we're making a public statement that we're putting them on the watch list.
Other
Like another plan sponsor, for example.
Other retirement boards, other folks that are in this space, we're making a public decision to do that.
Yeah, and so definitely it is a statement, and you being a state plan, I think this is something to keep in mind. And us as RVK are obviously we bringing them forward because we're comfortable with making that determination and watching them more closely. I think it's also important to highlight that this is regular occurrence within plans, that you're placing managers on watch, you're monitoring them, and then they could come off watch. So to the extent that this would have an impact, are you thinking of the strategy itself potentially going forward? Cash flow?
Well, I'm wondering if other plans are looking at what other actors in the space are doing, and then they might put them on watch, and this snowballs into a loss of faith of credibility of the managers if everyone's putting them on watch, and it has ripple effects later on. So I'm wondering, have we looked at other firms that have done similar types of actions, or other plans that have done similar kinds of actions, and what is the impact of us doing this in the public area?
I think we've seen that happen before in situations where you have a huge big public plan with a significant exposure to a certain strategy where they are one of the main investors that put the manager on watch. We see that's even more in the private space. That can signal something. I think we had a strategy, real estate, I forget, one of the real big core real estate managers, one of our clients did place them on watch and ended up doing a full redemption. And that was a meaningful piece of news at the time. But for a mutual fund where those occurrences happen every day, where you have so many investors, this is less of a consideration because any one plan tends to be a small piece of the pie eventually. So yeah, you're right. I think it's something to keep in mind, but it plays a bigger role in different, less liquid strategies than it would here. So I think it's a lesser concern here.
John makes his hand. I'll follow him. John Guthier.
Oh, hello. I had a question when we adopted this policy, I recently, and that was how many times, I don't know, I think I picked a period of 5 years, has there been the watch list put into use? And I'm embarrassed to say I don't remember what the answer was. Even if without a formal policy, we would put investment vehicles on a watch list. Is that correct?
No, it's not. In the past, it was a more informal process where I think it would be, if a strategy was underperforming, it would be noted in an investment review. And then, the board would consider it, but there wouldn't be an opportunity to take any, I mean, I guess there was an opportunity, but the practice was not to take formal action. It was to see it in the report, keep an eye on it, and nothing as formal as this. That's a large part why we were recommending to put this in place so that we could have a bit clearer record of what we were doing or not doing at any given time with respect to our oversight of these funds.
Great, Tim. Thanks for that reminder.
Sure.
That directly relates to the comment that I was about to make, which is it's not surprising to see these particular strategies put on a watch list to me, because these are strategies that Joe has been watching for years.
Right.
And your comment about the impact of this action, particularly on the Vanguard fund, it's so massive that our little action is just going to be, nobody's going to notice.
It'd be nice to think we're that important, but
Yeah, it's definitely like Tim said, we're just documenting your existing process, your existing review, and adding some structure to it rather than doing something completely different or new.
Right. And that's best practice for the board. You have an investment policy statement, to have formal processes, everything is documented. That's best practice.
Yeah.
That's best practice. And every organization does its own thing based on their investment policy statement. So, that state of Vermont is not talking to state of New Hampshire. Did you put this fund? Everybody's got different programs, this and that. And a lot of it is minuscule in the grand scheme of things, but you make valid points, no mistaken. But I commend you on having an investment policy statement. That's wonderful start.
And just to reflect back to John's question about how often this has come up in the past, routinely there'd be funds that were flagged to keep an eye on. We would often talk about, well, there's a good reason why that this fund is underperforming at the moment. We'd expect it to, as market conditions change, rebound. I think I only recall one occasion where it continued and we made a change in the fund lineup to respond to that. So it's a lot of watching and, I think less in the end making a change to the investment lineup. But that's just the historical perspective. I think that's what John was getting at.
Yeah, which is the right way to do it. I think we also always ask plan sponsors, you don't want to act on performance alone. Once you see underperformance, you don't want to be chasing that performance, because what happens, I think, and there's research to support that, cash flows chase performance, and by the time you move to this outperforming strategy, it starts to then underperform, because those tend to be cyclical. Whatever was giving it that extra boost in the last few quarters will likely shift in the next few, and their style may be out of favor just by the time you moved your money in. So understand if performance is cyclical versus systematic, and understand if it's something specific to the manager or just the market environment before you make a move in or out. So we do place a lot of managers on watch, but we end up making a move in very few cases.
That's a really interesting comment for me because I heard the time frames being mentioned being 90 days and maybe 180 days for action. How does that accord with what you just said about, periodicity of performance?
I think, John, oftentimes the action may be maintain them on the watch list or, things like that. It's really what it's meant to do is have us on a regular calendar to come back to the issue, because we wouldn't want to put it on a watch list and then not come back to it for a couple of years. So it's this action today is not sort of, step one to in 90 days for certain remove the fund by any stretch of the imagination. This action is just to heighten our level of review and get us on a more formal check-in calendar, if that helps.
Okay,
And
thanks.
in certain cases, if something material and fast moving is happening, and it's reflected in our investment policy statement and watch list policy, this board can take action and actually doesn't need to wait the 90 days. I think it's not meant to, on its own, drive an action. It's really just that heightened level of monitoring and documentation of what we're doing with respect to staying, moving, considering options, that kind of stuff.
There was a motion and a second. Any further discussion on the watch list? Hearing none, all those in favor of placing the Vanguard Growth Admiral, Impact Global Investment, and State of Vermont Value Fund on our watch list, please signify with an aye.
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 And those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it. And these funds will be added to our watch list and we'll revisit them accordingly.
So, Mr. Chair, I do think we were probably a little over ambitious with getting to the 457 fees, just seeing where the clock is right now. So I think what we'd like to do is in the next 15 minutes, do this a quick pass through the managed accounts overview, and then that'll take us home if that works.
That works for me. My only concern is making sure that the managed accounts section, can we get through that in 15 minutes? I want to make sure that has an adequate.
I think, what this is really just some background. And so you have the deck for further information, but I think we can get through that.
Awesome.
That's
Sounds
Sarah's
like a
challenge right now.
Challenge accepted.
Sarah also has an Uber to the airport that we want to make sure she doesn't miss her flight. So.
It's important. All right. So this one, just a bit of a background. I know Tim talked a bit about that, but staff and RVK felt you all had Goalmaker for a while now. And with the transition to Empower, you've added somewhat recently the managed account service. So my total retirement was Empower. And with that move also, Empower has all those additional robust set of advisory services that Prudential didn't have. So those have been turned on as well. So we felt it's a good idea to take a deeper dive, understand those services, maybe look a bit under the hood and make sure we understand what they are, make sure that the value justifies the extra cost for this new fee service, that the right participants are finding it, and that are using the program as intended. Fees are competitive. So that is what the review has been about. And we've already kicked off a review process. Gabe and Chip and team have been really important partners in all this. And they have helped us with this review. We held actually a number of meetings. We discussed retirement plan advisors with Chip at a very detailed level, and he's been very generous with his time with us there. We've sent them a questionnaire that they've kindly filled out for us, and this discussion is still ongoing, but we felt maybe before we share those takeaways with you at a future meeting, it's going to be good just to level set for us, understand. So what are the typical advisory services we see in DC plans? What are considerations for how to evaluate them? And we are planning to do for that review for you all. So with that, maybe before we jump into Empower services, we thought let's take just a step back and look at the advisory market in general. Manage everyone, when we talk about advice, everyone thinks manage accounts, but there is more to advice than just manage accounts. It doesn't exist in a vacuum. They are usually supported by other services, and there are different levels of advisory support that record keepers provide. And plans also tend to, use different services at different times. So we have plans that, choose the path of we're going to offer an investment menu that is complemented by simple educational resources. We're going to provide group workshops, webinars, additional resources for participants, tools, calculators, but we're going to stop there. And then there are other plans that think we want to do more. Folks need that extra help. So we're going to add additional advisory services or financial wellness programs. Some offer just point-in-time advice, so you can call the call center, speak to an advisor, or have those one-on-one sessions, and then others will also offer asset allocation services, which are typically fee-based services like the My Total Retirement. But what we like to say to plan sponsors, this is a very plan-specific decision. We don't have general recommendations about all plans should do this or should do that. It's really, you have to look at your own participant base and think, is what's best for my participants, what will be most helpful for them. So on that note, I think this is an interesting survey that we like to point out, and it highlights what I just said, which is there is no wide agreement about what tools, what services you should offer to a participant base. That survey asked plan sponsors about which services they think will have the greatest impact on improving outcomes. And you can see there is no agreement on any one thing. A bit more people think participant education or financial wellness tool will be helpful. But some also think one-on-one or asset management, through managed accounts will be helpful. And the reason maybe a bit more think education is helpful is probably because managed accounts tend to be something that some people benefit from, not everyone. Like a lot of people think if you're younger, if you have small balance, you don't really need to pay that extra fee to get this additional customization. So that's probably why you see that variation. But yeah, that's again kind of confirms that every plan needs to make that decision for themselves. And when surveyed, I think a lot of surveys point to the same thing. So about 55% or so of plans in one survey don't offer advice. Another plan shows something similar. In our own participant base, we also about 50% of our plans offer managed accounts. If you look at usage, however, by participants on the bottom right-hand side, about 9% of participants or so use advice. And they typically are offered as an opt-in solution, although there are plans that offer it as the default option, but that's not typical. And then when it comes to the market itself, the marketplace, who are the main providers in this space? And this is actually a space that has been historically quite concentrated. Historically, Edelman Financial Engines and Morningstar have always been the managed account providers. More recently, Fidelity has been big as well, but they are only available on their own platform, the Fidelity platform. There are others that started to come into that space. Vanguard, Goldman Sachs, starting to gain market share. So those numbers will likely look different today, but by far those two names still dominate, and both of them are available through Empower, so as options for My Total Retirement. Before we jump into the Empower review, just from a high level, this slide shows how much these services can really vary between providers. Because if you are new to this, I think you might just assume all managed account providers are doing the same thing. They're just, designing the portfolio, rebalancing it for you. But it actually really varies. And some providers will go much further. They will provide, advice on how much to save, when to retire, how to draw down your assets, how to take distributions from the plan versus pension. given, your pension income, when to claim Social Security, while others are very focused on this is how you should invest, and it's more bare bone. So, and then also the services and the integration you get will really also vary as well. Morningstar integration with the Empower platform may be different from EFE, but also Morningstar's support on the Empower platform will be very different from Principal or another record keeper. So when we do those reviews, we have to do the due diligence on the record keeper level. We don't just have a general opinion of Morningstar. And that's why we need to work closely with Gabe and Chip and their team to make sure we understand how the service is positioned on their own platform, how it's communicated, how they engage with participants about it, how it's being reported, and all of that is very, very record keeper specific. So with that, we can maybe talk a bit more about Empower more specifically and Vermont, unless there are any general comments or questions first. All right. So Empower offers the same 3 layers of support we generally see across record keepers. The most involved one, the do-it-for-me version, is the asset allocation service, the My Tool Retirement. This is a full portfolio management service where they have full discretionary authority on participants' account. They make the adjustments on their behalf without any involvement of participants. And this is the highest level, they assume the highest level of fiduciary role, which is a 338 fiduciary role. So meaning they are required to act fully in participants' best interest. And then they also offer point-in-time advice, where they simply act as an advisor, a 321 advisor, where they are making recommendations to participants, and participants have to approve those recommendations first. So they also act as a fiduciary here, but they act as a co-fiduciary with participants who are the final sayers there on what takes place. This is the second layer of support. They still have to act in their best interest. They still have, a fiduciary role to uphold. And then finally, they offer education. So that's the Empower Learning Center. That's all the tools and calculators and the call center support with general account questions. There's no fiduciary role that they take for those services. And then there's Goalmaker, which is a bit unique. I wasn't actually sure how to position them on this chart because they are an asset allocation service. So they are a do-it-for-me service, just like MTR, but they're unique in that neither Empower nor Morningstar serve in any fiduciary capacity when it comes to Goalmaker. So the plan fiduciary is responsible for approving any changes to the model portfolios before they get implemented. Morningstar is simply designing the portfolios, and then Empower is maintaining those model portfolios. But from their standpoint, they are offering them as an educational tool or education on potential portfolio allocations based on the core menu options. So that's an important distinction. And the reason they can do that is because this is a free service. If it was for fees, they would have had to take that additional fiduciary role. So that is something to keep in mind there. So the plan fiduciary here is responsible for reviewing and approving the model portfolios, make sure the investments are reasonable. And I guess that's the trade-off when you offer the free service. We tend to see Goalmaker offered more often in smaller plans where there's actually an advisor helping build those model portfolios and taking on that 338 role. So that advisor would then charge a fee that would be on top of or taken from that Goalmaker portfolios. So that's where we typically see Goalmaker. There are some larger plans. You are not the only one offering Goalmaker in this manner. There are others, and I believe there's one plan where they are offering, or there are maybe a few plans where they offer it as the default option. So that we see that too, but it is commonly offered with that model where you work with an advisor who is taking that additional fiduciary role. In the larger plan space, obviously, they tend to offer something like My Total Retirement, where it's a fiduciary service for an additional fee. This slide kind of gets into some of the nuts and bolts of that role. And I just wanted, I know we're running out of time here. So one final note on GoalMaker: Empower is only making GoalMaker available to their existing legacy clients, meaning this is not something new plans can get into. And based on conversations with Empower, a lot of folks even decided to completely remove GoalMaker with the transition to Empower and just use MTR instead. So the next few slides show some trends and data on Empower and the usage trends. Just a quick metric. They generally see about 17 to 18% or so, or 14 to 18% of participants enrolling in the program, compared to that 9% that I shared with you earlier, which was a more general number. So I guess there are slightly higher enrollment in managed accounts that we're seeing on the Empower platform. And this slide shows your Vermont specific data points relative to our client database. So very quickly, before we wrap up and see if you have any questions, enrollments across, we're showing enrollment here across the plans, but for the 457, 4% or so, I think it's now up to 6% or 6.5% are in the program. Our plan median as of end of last year has been around 5%. Your average balance in the 457 is in the 60,000 range, a bit lower than our plan average. And then your managed account fees are very competitive, 35 basis points. That's pretty much in line with our plan average as well, 34. But of course, the one distinction here is that this is a flat fee. Our typical plan pays a tiered fee. So at your low balance level, that's 60,000 or 59 or so, you're probably in a better place with this fee than with an asset-based fee, where you would typically be paying 40 or 45 basis points. 45 potentially is typical. So overall, I think there's more to come. I think we have an evaluation framework that we show on this page. We think it's important to understand, fees are competitive, but is there value being received that justifies those fees? And that's important. To do that, we look at who's using the service, how are they getting into the solution, do they understand the service when they are getting enrolled, and is the investment approach reasonable? Are the recommendations, are they reasonable? Do they make sense? You need to do that just the way you would look at the target date fund, light path. And then how are people being engaged after enrolling into the service to make sure they update their profile? Because with those services in particular, if you're not customizing your profile, then you're not getting any value for those fees. So you really need to do that. So all of that will come at a future meeting. And of course, I think to bring it home, we don't really think that your goal here or your role is to be micromanaging those accounts or looking at every portfolio. Every participant's portfolio will be different, but it's to make sure that there's a structure that makes sense and that there's value being added and that the service is competitive, which is going to be our goal here from this review. And more to come on that. I think we'll work with Empower and staff to finish that review and come back to you with our takeaways and any recommendations. So stop there to see if any questions or comments.
Thanks. I'm pleased to hear that there's more to come on this, and I would like to better understand, particularly GoalMaker, its structure. What's the design? What are the goals the GoalMaker tends towards? How does it take the parameters that I set in GoalMaker and apply that to my portfolio and make its allocation? So love to have answers to those kinds of questions.
We will dig deeper.
My comment dovetails with that again for the future. When we see this again, I'd be interested to know why people who had access to Goldmaker chose to not offer it after the transition. Just to me, it seems to kind of do target date like things without the target date expense, which can kind of be high for funds. So just why not off? Why our plan sponsor saying no? We don't want to have that as an option. So it just, you know, when we have it discuss it more in the future, some perspective on why sponsors would consider that would be helpful.
Yeah, no, we'll talk more about that. And yeah, some of that will be likely driven by some of the considerations I shared with
Yeah,
you.
I figured.
And
Yeah.
yeah, so more to come.
Thank you.
So I think that's from a staff perspective. This is everything we wanted to cover except the 457 fees, but we'll move that to the next agenda. And
Sounds great. Any other business come before the board today?
Mr. Chair, the only thing I want to just share is an email I got because this is really directed at you folks. People don't usually email to say good job. I don't know what it's like in all your spaces, but we just got an email from someone that said, nicely done on driving down the management costs of funds offered in this plan. Not many people would notice, but I see that you're being excellent stewards of the people you protect. And this is clearly as a result of the share class change that we're getting this because those notices have gone out. So just to kind of piggyback off the work here that we're doing with RBK, with Empower, it's providing real results to members, and it's because of the work you guys are doing. So I just wanted to share that.
Sweet. Thanks for sharing that. I appreciate the person taking the time to share that perspective.
Yeah.
Yeah, great.
Any
What's that?
No, I was just asking Adam if that was if he emailed you.
Hold on.
Didn't want to out you, Commissioner.
Just as a matter of logistics for the December 11th meeting, VSEA also has a meeting in Montpelier that Eric, John, and I will be at. So Eric and I discussed, we plan to be here in person for the next meeting. Just so Bill knows he's got to open the door for it.
It's always open when we have a meeting, consistent with Justin's guidance.
Yeah. It's a good tip. Thank you. Any additional comments?
Move to adjourn.
Motion to adjourn has been made. Is there a second?
Second.
There is a second. And it's not debatable, so all those in favor, please signify with an aye.
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 All those opposed with a nay. Not hearing any, the ayes appear to have, the ayes do have it, and the November meeting of the Vermont State Employees Retirement System is adjourned. Thank you all. Appreciate it.
Happy holidays, everyone. Be well.
Yeah.
Thank you.
Thank you, Gabe.
Thank you.
Good